All right, good evening, everyone. I am sorry about the technical difficulties we experienced to start this presentation. As those of you who've been patient on Live Go using your Bloomberg app, we do appreciate that. Unfortunately, we had a technical glitch with allowing badges to print to allow attendees today, and we do apologize for that. However, we are going to still continue with a full format with a minor shift in the speaking orders as well. But essentially, let's get down to business. This is the annual CPM Gold Outlook. We've hosted this for several years with CPM, and we're pleased that we continue to be able to do so and change the format over the years to modify and meet the needs of our clients, and also essentially to use technology, in this case Live Go, so that some of you can listen in and in the future be able to view this presentation in the archived formats. Now, we're hosting today for a number of reasons, but we feel the topic is completely in line with the Bloomberg commitment to bring market knowledge and thought-provoking events to our user base and other influential financial market participants. The successful format of the 2014 CPM Outlook session continues this year with some brief speaker sessions by the invited panelists before we break into the moderated panel by another Bloomberg application specialist. My name is Todd Sybilla. I'm a commodity application specialist here in New York for the North American regions. Today, we will have a number of distinguished participants brought to us by CPM, and Jeff Christian, Rohit, Savant as well. We have Henner, Asche, the Deputy Head of Markets Department at the Bundesbank. Welcome back. We have Harriet, Hunnable from the CPM Group. We have Chantelle, Schieven from Dundee Capital Markets. We also have a roundtable that, again, is hosted by Stephen Jonathan, who's our FX and economist application specialist at Bloomberg. We will also be including in the panel one of Bloomberg intelligence economist, Josh Wright. So we're happy to showcase the yearbook. And we're happy also that CPM continues to utilize the Bloomberg service. Many of these discussion themes you're going to hear today are available on your Bloomberg with reference to source data and analytics from the content that Bloomberg collects as well. As always, we're going to be willing to provide individual overviews for you. I want to touch on a few of these themes that you're going to hear today and how you can use Bloomberg to follow up. For those of you in the audience, you have a number of leave-behinds that are on your seat, things that talk about key market functionality. We have an overview on the aggregation of data and the thematic overviews that you see in the Bloomberg Intelligence for precious metals. You do also have a overview sheet on how the Bloomberg commodity market brochure actually addresses a lot of the components out there. For sake of brevity, I'm not going to spend too much time on functionality. I am going to send a follow-up email to all of you that we've spoken to out there, as well as those of you in attendance with a lot of the screens. But I do want to show some key things. First of all, I'd like to showcase one of the new things that we're doing with news. Using the keyword searches, specifically for gold today, I'd like to showcase a couple of components. As you know, what we do is we do collection, we do a lot of Bloomberg generation story, and we also do a lot of Bloomberg exclusives. In this case, we had a story come out yesterday on the Fed Chair Yellen giving some gold bull big rally news that was exclusive to Bloomberg. I think this is very, very important from the standpoint of it showcases knowledge content generation that we have from Bloomberg as well. This is key to market driving information and components that are in the market. You're going to see economic news as well that's going to be found in here. You're going to see news also on mining demands, costs, et cetera, throughout the news feeds as they come in. And our speakers today are going to touch on these themes and also give you a forward outlook on where they see gold and the economic landscape going, given the depth of the panel that we have. In the FX community, the issues that are facing the regional markets are pretty significant. If you think of it in terms of past, present, and future as the types of things that you're going to look at Bloomberg and try to analyze, I'd wake up with a function that would give me a snapshot of the past year essentially what's gone on with the strengthening dollar regarding performance, showing that dollar affecting the G10 currencies that are out there. And you can see with your spot being the US dollar, you can see that strengthening dollar and the effect that it has on the G10 currencies during that time. A more present snapshot might give me a look at and demonstrating the concept of implied volatilities. Here, for example, let's showcase that the average implied vol over the last 3 months has been 7.5%, but we're looking at a vol right now that's approximately 80% higher or so than that. So you can see vols are spiking right now. That's the story at present. Future forecasts, well, there's a lot of functions on Bloomberg that do this, right? Keep in mind, again, what we're doing here is we're aggregating data. We're looking at data across the board. Where are rates now versus where they're forecasted to be? Think of the aggregation in the community in general. There's 94 analysts that are posting within here, and you can see essentially where they see the euro now, and even going out a little forward. Look, stretching out into 2018, you can see almost a return to where the euro inception rate of $1.18 was. So it's interesting, to say the least. This type of functionality continues even in the cross-sector of commodities. I will do the same sort of thing here in a function known as CPFC, where I can snapshot and I can see essentially a gold outlook and a forecast with 31 analysts that are out there in the community forecasting where they see gold in the forward market. This type of data and content, again, is what we're trying to do. But we also know from the news, we saw that the price of gold is not the only factor challenging the community today. The mining companies themselves, being able to track individual companies, their costs and margins, has increasingly become the call that we're hearing either from investor relations, the sell-side analysts, or the investors in the products as well. So using a lot of the currently collected data, think in terms, again, some of the tools that we do really well on Bloomberg. By organizing and collecting data, you can pretty quickly aggregate and look at snapshots of peers, right? If I want to look very quickly at one of the key components affecting seniors, mid-tier, and the juniors is your all-in sustaining cash costs as released by the company. So I'm able to not only look at what the average is over a quarter-by-quarter basis, but I'm also additionally able to do a peer-by-peer comparison in some of the excellent components that are done here. As for future estimates, again in the companies, let's talk about the analysts again. One of the new components of the Bloomberg Best Estimates is to be able to track and collect the estimates that are coming out from the DCF net asset values that you're seeing in the community. Here's an example of where we're collecting the estimates for those NAVs by a large grouping in the community based on the companies and the standardization in the data. As a matter of fact, one of Chantelle's analysts is also showcased in here as well. So you can see how a lot of the community and the speakers that we have coming up are going to be represented in here as well. This continues with the suite of economic display as we build these out to meet what people are looking for, aggregating by industry tabs. I can also come in here and very quickly snapshot and see the community in general as far as production costs, sales volume, etc., all within that community. So you're seeing great tools for past, present, and future estimates being represented now in FX and in the commodity sector as well. The demand for gold and the stresses in the at the top of the food chain, also with the central banks, can be pretty readily defined when you look at the impact. And as we have Henner, Asche in the audience here today, we can also see, if I look at gold reserves very quickly, the impact of the statements regarding the German gold reserves. Tools and such. Harriet Hunnable from CME will be here. She'll be talking about a lot of the, I'm guesstimating here, a lot of the growth with regards to the types of tools that are in the marketplace now that the investor has in front of them. Pretty quickly looking at the proliferation of the exchanges and the products that they put out there for the different types of investors that are there, whether it's regional or whether it's based on size, as we see different types of micro and mini contracts coming available to impact and reach out to additional investors. There are different things that people talk about, that you read about. We know the CFTC net longs is always something very interesting. We know it's spiked, and we also know where those net longs now are with regards to driving the price of gold. So we're seeing these types of tools, changes in the gold fixing rates that are being represented and how that's being handled. I'm able to look at the ETF holdings as well in particular and be able to track to see that retail money, where has it gone, whether it's moved from gold to other vehicles as well. We have these different types of headwinds that have been out there that have even affected the LBMA. We're going to have a lot of these types of components in there. I draw back attention again to some of the things we do with the types of tools that you have, the concepts of downstream consumption, whether those are industrial. This is from the BMAP precious metals pages, industrial components to jewelry demand components as well. All this collected data showing up within these different types of blades that I'm going to look at here if I want to look at supply and demand, pricing, etc. All of this type of information. Again, aggregation, I talked about analysts. Now I'm talking about the aggregation with regards to a lot of the data that's coming in from supply sources that Bloomberg reaches out to. Again, the supply demand, ETF holdings, etc. Money supply, all of these types of tools. There's obviously a tremendous amount of tools and data available to you, and we're going to strive to bring these tools and content available to you and help for these types of analysis. As you hear these thematic types of ideas that are put out by the group in front of us, you also see these types of things being showcased either by analysts that are on Bloomberg, some of the Bloomberg analyst team, as well as other individuals. I hope you find these ideas useful today. As I said, I'm going to follow up with a lot of material that's going to be content-based. I appreciate that. We're going to break now into our speaker sessions as well. And without further ado, I'm going to hand the podium over to our esteemed colleagues at CPM. I want to welcome Jeff Christian here and thank him for his patience as well. Let's get you up. Yeah. There you go. This is you. Okay. You want me to start your slideshow, or are you good from here?
Yeah. Please start it. Yeah.
Okay. Thank you, Jack.
Thank you, Todd. Again, CPM Group also wants to apologize for the problems and delays in getting this all set up, and I think we still have maybe one more wrinkle to iron out, but we'll soldier through it. Todd has given you the schedule for the day, so I won't bother to repeat that. I will start by thanking our sponsors and partners for the CPM Group Yearbook. We have a number of sponsors, including the CME Group, various depositories, investment groups, Gold Corp and Goldfields, two of the largest gold mining companies in the world. Goldfields is a new sponsor again this year. Scrap Recyclers, Kitco, Monex, New Zealand Bullion Depository, I want to point out as another new client. I'll mention them again in passing in my presentations. Sabin Metals, Noah Capital. And then we have our partners in China who translate the report into Chinese and distribute it there. The China Gold Association, who is our partner in the program, and also we are their international advisors, China National Gold Group and Jingyi Gold. I want to talk about what gold prices did and what they have been doing and where we think they're going. And then I guess hopefully people don't leave. Gold prices fell about 10.2% last year. The average price was $12.66. That was the second year of declining prices in gold. So far this year, the price is off. Year to date, it's off about 5.7%, running around $12.19, $12.20. Our expectation is that the price will be relatively flat to weak in the second quarter into the summer months, 2015. We expect some strengthening in gold prices in the final 4 months of the year, similar to what we've seen in other years. And then we think that in 2016, the price will move up a little bit more and with further increases as time goes by. Todd alluded to the fact that there are some structural changes going on in the gold market. It's a very interesting time to be in the gold market. We've seen the International Free Trade Zone, what the Shanghai calls the International Board, open up in China, allowing people to use initially overseas Chinese yuan to invest in gold in a free trade zone within China. The expectation is that at some point they will also allow other currencies to be used to purchase, buy and sell gold in the trade zone. And I think there are further liberalizations in the works in the Chinese market, which are going to make it very interesting over the course of 2015 and 2016. We've seen the change in London pricing, not only in gold, but in silver, platinum, and palladium. And we're moving toward a more electronic, more modern system of pricing metal used in benchmarks in contracts. Our own view is that the moves that have been made so far are good. There probably will be further permutations as technology changes and as regulators have a say in how they think these things should be working. The CME, we're glad to say, has been doing a lot of work on modernizing its markets and responding to issues. And I won't steal, I hope, Harriet's thunder. They have a new gold kilo contract, which is deliverable in kilograms in Hong Kong, universally traded, very interesting. They have made some moves to improve the efficiency of the silver market, and they're being very responsive. All of this comes at the same time that there's a change and a shift in market power. And I mentioned that we have these partners and we go to China and we make presentations for our reports. And in China, there's a big question why, if we're the largest mining country, refiner, investor, and user of gold, do we not have more market power? And our response is, you actually do have the market power. It's reflected in prices that are formulated in London and New York, but you do have the market power. It's there. And you're seeing major shifts, and I'll show you some charts that are kind of interesting in a minute. And you're going to continue to see shifts. And they're coming part and parcel with increased regulatory issues and increased modernization and an increased diversification in the structure of the market. All of which I think will be a net sum improvement for the gold market over time. Our view is that ultimately the price of gold, it's determined by a number of things: mine production, secondary supply, fabrication demand, central bank transactions. All of those things have an effect. But our econometric analyses over the last 30 years or so, 35 years, have shown to us that the single most important component is investment demand, which is why in our gold report, the first section of the fundamental discussion is investment demand. And if you look at what I just said, our price view is, which is relatively flat prices for the next several months, rising slowly in late 2015, accelerating in 2016, and then possibly moving at a more rapidly increasing rate 2017 to 2020. That reflects our views of the economy. We have been for several years in this muddle through growth period, and it's probably going to continue. There are people who tend to expect the worst, and there are people who tend to expect the best. But in reality, economic activity tends to be in the middle ground. For many years, I used to say that the gold market a lot of gold market participants see the gold market in black and white, where in reality, it's a myriad of shades of gray. And I guess popular culture caught up with me, and I stopped saying that for a while, but it's true. And you look at our economic view, which is relatively modest growth in GDP, low inflation to disinflationary pressures, lower interest rates in 17 major countries and economies so far this year, and a postponement in the what we see as irrational proposed increase in U.S. interest rates for some time now. And you look at this economy and you say, okay, it probably doesn't support stronger prices. We are muddling through. There are people in the market, the gold bugs, who say, no, we're going to have hyperinflation. We're going to have the dollar collapse. We're going to have the euro collapse. But those things tend not to happen. If you look at the recent issues related to Greece, no one involved in the Greek discussions, including Syriza, was talking about Greece leaving the euro. No one was talking about a collapse of the euro or Greece exiting the EU economic union. But in the gold market, all the bloggers were talking about it. They had an irrational expectation, and when that happens, the euro is going to collapse and gold's going to skyrocket. Well, it hasn't happened. It's not going to happen, and they're going to be disappointed. It's just the way it is. We're looking at relatively modest growth. We're looking at a continued slowdown in Chinese growth over this year into next year, but basically growth staying in that 6.5% to 7.5% rate, which is the target growth rate for the Chinese government. The dollar hasn't collapsed. In fact, it's 27% higher than it was at its low point in 2008 against the euro, and it's 15% higher on a trade-weighted basis. Nor has the euro collapsed, nor will it collapse. Money supply, actually on an OECD basis, has been relatively modest, and it hasn't led to hyperinflation. And there are a myriad of reasons why it doesn't necessarily need to lead to hyperinflation. And then OECD inflation, again, as we've been saying for years, hyperinflation is not the concern. Disinflation is the concern, and it continues to be. I always get concerned when people from the Bundesbank look at my data on the OECD and say, oh, and then U.S. inflation. The blue line is core inflation. You've seen higher inflation because of higher oil prices and at periods of time food prices. But if you strip out food and energy, you can see that inflation has been relatively modest. We're still at risk of disinflationary pressures and deflationary pressures rather than inflationary pressures. I want to talk a little bit about how gold is used. One of the things that we've seen over the last year and a half, where people looked at CPM Group's data, at the World Gold Council's data, and they've said, we think that Chinese demand is probably 2.5 times what the China Gold Association, CPM Group, the World Gold Council, and others say. And what I'm trying to do here is show you how gold is used in fabricated products, including jewelry. If you're casting gold jewelry, you have about a 50% scrappage rate. If you're using sputtering targets, either for jewelry or electronics or other industrial goods, you have a 70% scrappage rate. You take a 1,000-ounce gold sputtering target and you use it to plate goods. And at the end of that, you have 700 ounces of scrap that gets reprocessed, re-refined, and reused. And 300 ounces of that 1,000 ounces goes off in product. So if you look at the Chinese or any other market, and you say, let's have a hypothetical fabricator who's taking 10,000 ounces off the Shanghai Gold Exchange a month. And he is, in fact, using 10,000 ounces a month. So it's totally correct to say he's using 10,000 ounces a month. However, only 3,000 ounces of that is used in new products that he sells. The other 7,000 ounces gets re-refined, re-delivered to the Shanghai Gold Exchange, repurchased by fabricators, and reused. And if you look at that loop and you annualize it, you can see, or you can look at it on a monthly basis. If you say, oh, he's using 10,000 ounces because that's what he took off of the SGE, instead of 3,000 ounces, which is what he actually used in finished products, you will overestimate fabrication demand by 233%. Roughly equal to what people who say that the CGA, the WGC, and CPM Group are undercounting. So it's really that simple. And interestingly, as we use this And we talk about this, and we talk about sputtering targets, exchange rate. It's amazing the people, producers, industry associations, who have no clue that this is how actually gold gets used. It's a very simple thing. Any engineer could tell you it, but engineers don't run gold newsletters. Now, I have a couple other charts I want to show you before I give the microphone over to Rohit and Muli to talk about investment demand, supply, fabrication demand, and central banks. Everyone has been talking about how gold is moving from west to east, and it's true. China has invested about 48 million ounces, 49 million ounces in gold between 2008 and 2014. Net investment demand for gold not in jewelry form in China, 48 million ounces. It's a tremendous increase from virtually nothing a decade ago. And you've heard in the gold market, oh, there's no gold left in London, New York, or Switzerland. But if you look at net imports into Switzerland, and you can see this big surge in gross exports in 2013, it fell back in 2014. Gross imports were greater. And if you look at the net imports, you can see, whereas net imports were about 20 to 30 million ounces a year from 2008 through 2012, it did fall to about 10 or 11 million ounces in 2013, and then rose a little bit more in 2014. And if you add all that up and you strip out maybe the 5 million ounces that were used in watches, jewelries, and electronics in Switzerland, you have about 158 million ounces of additional gold that was stacked up in Swiss bank vaults and private non-bank vaults in Switzerland between 2008 and 2014, or about 3 times as much as was bought in China, which is why the vaulting capacity in Switzerland has quadrupled since 2008. It's not that the vaults are running out and that the vaults are empty and you can play hockey in them. There's actually been this tremendous amount of gold stacked up in Switzerland, in excess of what there was in China. Not that China's not important, but let's be honest, gold is a universal investment. And this is a really positive factor because now you realize gold is not a China story. Gold is not dependent on China buying gold and taking all the gold. This is a universal thing. And you can see, if you look at Malaysia, very steady demand for gold from 1997 to 2007, about 500,000 to 1 million ounces a year. 2008, during the economic crisis, somebody brought in about 5.7 million ounces. Some of that was Malaysian demand. Some of it was investors from the Gulf region who said, I want gold, but I don't want it in my home country for various reasons, and I don't want it in the United States or Europe. And here's a very good, well-developed, economically positive, with a very strong sense of law, and a constitution based on the U.S. Constitution, Islamic State. So let me put my gold there. And since 2008, you've seen about twice as much gold going into Malaysia year in, year out. We put it in a different color because some of that may actually be central bank gold or sovereign wealth gold. But again, it's not just China. Now, I also mentioned New Zealand. We have this client, New Zealand Bullion Depository. They're a new depository, a really fascinating depository, state-of-the-art technology, really fabulous, and it's in New Zealand. Gold is being bought around the world, and it's a universal investment. My last slide before I turn over the microphone has to do with net and gross investment demand and what happened in 2013, because it was a phenomenal year for gold and it was extremely telling. What you see from us and others are net investment demands, which are the purple bars here. And it was about 38 million ounces in 2012, and net investment demand fell to about 34 million ounces, 36 million ounces in 2013. And then it fell a little bit further to about 28 million ounces in 2014. But that net figure is composed of gross numbers. And if you go back to 2012, we don't publish traditionally gross figures because given the secrecy of gold and silver markets, the spurious nature of the data, plus or minus 50% accuracy, if you will, has always given us pause. But what we saw in 2013 caused us to say we have to tell people about this. And if you look at 2012, our gross estimates are that net gross investment buying probably was about 42 million ounces. And you had maybe about 6 or 8 million ounces of gross selling. And that averaged out to that 38. Excuse my math, but I have a head cold, so I'm going to claim infirmary. In 2013, we had 28 million ounces of gold sold from ETFs. Short-term investors who were saying, you know what, the dollar hasn't collapsed, the euro hasn't collapsed, Europe's doing better, the United States doing better, there's no hyperinflation, we're moving forward as a global economy. I'm going to sell my gold and put my money in the stock market in the US because it's rising and gold prices are weakening. And you had about 28 million ounces of ETFs, which are publicly reported, that were sold in 2013. And you had maybe another 20 million ounces of gold that was sold from private inventories by short-term investors. And long-term investors who had really pulled back from the market at $1,700, $1,800, $1,900 an ounce in 2011 said, if you want to sell me this stuff at 13 or 12 or 1,100, I'll buy it. And you had about 82 million ounces of gross investment demand. That's almost as much gold as was mined in the market economy nations that year. And it's probably unprecedented. Last year, things sort of returned to normal. You saw a little bit of selling from the ETFs. You saw a little bit of selling from other short-term investors just getting out, disenchanted investors. But you still saw probably more than 40 million ounces of gross purchases, which were translated into about 28 million ounces of net purchases. Rohit will give you the real accurate numbers as he talks about investment demand. Thank you.
Thanks, Jeff. So I'm going to walk you through investment demand and supply. So let's start here with investment demand. Once I know how to figure this out. Okay. So investment demand declined last year. It dropped to about 28.3 million ounces, down from about 33.5 million ounces in 2013. Clearly, that decline in investment demand had a major role to play in the weakness in prices that we saw last year. If you look at investment demand in 2014, it is still pretty high compared to where it's been historically. And that explains that despite that decline in investment demand that we had, gold prices were still higher than any level they had been at prior to 2010. So that's an important factor to take into consideration. A lot of the short-term investors have been getting out of gold last year, and that trend is expected to continue this year, at least for most of this year. The longer-term investors, meanwhile, have been buyers whenever prices have been coming off. They've been cautious buyers, but they are really the people who've been contributing to this high level of net investment demand. This chart essentially shows the same data ranked over the last 50 years. And you can see that, even though investment demand came off in 2014 and is expected to decline slightly in 2015, it's still pretty high. It's still in the top 25% over the last 50 years of data that we have. And in the 80s and 90s, when gold prices were weak and depressed almost, investment demand at that time was typically below 20 million ounces. So we still have a substantial amount of investment demand for gold, which we think would help sustain prices at elevated levels. So I guess the most anticipated and debated question is, when would the Fed increase interest rates? We think maybe sometime later this year, maybe sometime in the first half of next year. We don't think that there's going to be a big increase. We don't think that the increase would be a rapid one. And we don't think that it would have any significant impact on the real economy. What it is likely to do is keep the US dollar at elevated levels. And this can have the dollar and gold sometimes move in the same direction, and then other times they move in inverse correlation to each other. So if investors are buying the dollar and gold as a safe haven, those are times when you start seeing the two assets move in the same direction. This time you're seeing the dollar strengthen because of an improvement in the US economy, the potential for an increase in interest rates, and that's likely to kind of weigh on gold demand from investors. An increase in interest rates is likely to slow the growth in stock markets, which have been rising from strength to strength over the last few years. You might even see a sharp decline, and both of those factors is potentially positive for gold, because you might see some of that money flowing towards the gold market. What do we think that an interest rate increase would do for gold? We think that there's limited downside for gold if interest rates increase. You probably see a brief spike down, but most of the expectation of an interest rate increase is already factored into the price. So we don't really see any sustained decline in gold prices if there is an interest rate increase. We in fact think that once the announcement is made, it might help investors to refocus their attention on other factors, broader macroeconomic issues, which should bring them back into the gold market. One of those major macroeconomic issues is this increase in government debt. So between 2007 and 2013, you've seen a substantial increase in government debt to GDP. And this basically shows you that governments now have a smaller cushion or less of a cushion to do anything in the event that there's some sort of a financial or economic problem in the coming years, which is a good reason to be invested in gold. We look at a variety of factors to kind of gauge what investment demand would look like. Inflation, we don't think, just let me start off with saying that in 2014 and 15, we kind of see the same sort of trends across all of these factors. Inflation, we don't think is an issue. In fact, disinflation, as Jeff mentioned, is more of an issue in the global economy at the moment. Investors, we think, would buy gold as a safe haven because of all these macroeconomic issues that you do have in the global economy. You did start seeing investors buying gold as a currency hedge. There's been an increase in currency market volatility in recent months, and that is definitely something that would encourage investors to buy gold as a currency hedge. As a form of saving, you do see gold being bought as a form of saving, especially in developing economies, but also in other parts of the world. And then when we talk about gold being bought as an alternate asset, we're basically talking about funds or investment houses that would be buying gold as a form of diversifying their portfolio. And quite often what you see is that the investor would want to hold a certain percentage of their portfolio in gold. So the weakness in prices that we're seeing right now basically would result in an increase in the amount of gold that they need to hold to match up with that level of whatever their stated percentage in the portfolio is. So we see that as being something that would be positive in the given environment, in the given price environment. And then as far as buying gold as a commodity that is based on its fabrication demand and supply fundamentals, we don't necessarily think that that's going to be something that would influence investors, because you don't particularly have very good supply versus fabrication demand fundamentals. And Mo and I will get into that further in the presentation. So this chart basically shows how currency market volatility has been going up. It started somewhere in the middle of last year. You had a couple of years when currency market volatility was coming off, but given the divergence in central bank policies across the world, you have seen an uptick in the volatility in these markets. A value investor would look at this as gold prices have come off pretty substantially. Stock market has been rising from strength to strength. There's a pretty substantial potential that the US equity markets especially would likely stall or grow extremely slowly and not in the same rapid fashion that we've seen in the past few years. And that might push some investors towards buying gold. And so we basically see this development over the past few years as positive for gold going forward. Gold has come off alongside other commodities, but it has performed relatively better compared to the complex as a whole. Gold coin demand was strong last year. It was off from levels that we saw in 2013, but it's still pretty strong and pretty healthy. 2013 was an exception because you saw gold prices come off for the first time after nearly 12 years. So you saw a big rush into investors buying gold coins. But that said, you're still seeing a substantial amount of demand from gold for gold coins from investors, and these are usually the longer-term investors, so they tend to be a little more price sensitive. So when you look at this chart, for example, what you're looking at is the premiums, and the areas that have been shaded are times when the gold prices weakened, and in those periods you saw premiums jump up, which suggests that these investors are fairly price sensitive, and every time you've seen prices come off, you've seen them rush in and buy these gold coins. Gold ETF holdings moved up a little bit in the first 2 months. They're still in positive territory, though a lot of the buying that was done in the first 2 months has now been liquidated. So on a net basis, you have an extremely small increase as of the end of last week. So in the middle of 2013, you saw gross short positions held by institutional investors reach record high levels. And since that period, you've seen gross short positions come close to those record high levels on various occasions, most recently earlier this month. That said, net long positions held by these investors has remained positive. They have never dipped into negative territory. And that's largely because you see that the gross long positions have sort of remained on average around 18 to 19 million ounces. And that kind of shows you that there is a substantial amount of, the investors do get nervous from time to time, but there is a fair amount of a positive outlook towards gold, and they're not getting out of it hand over fist. So with that, I'll move on to supply. Total supply rose in 2014. It was still lower than 2012 levels, however. And that's basically because you've been seeing a decline in secondary supply, which is influenced to a great extent by prices. Mine supply, however, has been increasing, and we expect that it would continue to push total supply higher, which this year we think would be comparable to levels that we saw in 2012, even though we expect secondary supply to be coming off. One of the reasons why you're seeing that mine supply go up is because you saw a substantial amount of new mine capacity being added between 2011 and 2014. A lot of that mine capacity came on stream because you had gold prices going up for nearly a decade, and that definitely encouraged miners to bring this capacity on. The red block, that's 2013, and as you can see, that was the year when you saw a lot of big projects come on stream, and you're still seeing those projects being ramped up through most of 2014, which is what helped mine supply go up. When you look 2015 out through 2019, all of the mine capacity only accounts for about 23% of what came on stream between 2011 and 2014. So that goes to show how many projects have been either delayed or pulled off, and that supply, the growth in supply we expect would sort of slow down over the next several years. Another thing we've noticed is that the cash cost of a lot of the new projects that have been brought on stream in recent years is much lower than what you were seeing before. So in the projects that came on stream in 2011, on a production weighted basis, it was close to $900 an ounce, whereas now it's about half that much. So clearly only projects with low costs are coming on stream in recent years. All-in sustaining costs have been declining since the second half of 2013. During the first half, when prices hadn't really come off, you were seeing all-in sustaining costs go up. In the second half of that year, however, you started seeing a sharp decline in all-in sustaining costs, and that's continued through 2014. So when you look at it on a year-on-year basis, the declines are pretty substantial, which is the percentage changes that you're looking at on the chart. But when you look at it on a quarter-on-quarter basis, it's sort of slowed down in 2014, and that's largely because cash costs are much harder to bring down. When you look at costs, they've flattened out. The decline has slowed, as I mentioned in the previous chart, but they're still lower than where they were at the peak during the second quarter of 2013. And one of the main reasons why those costs are not coming down as rapidly is because cash costs cannot be brought down quite as quickly. If you look at when that data is broken up between sustaining costs and cash costs, you'll see that sustaining costs came down pretty substantially, and that's because mining companies find it much easier to bring those costs down. However, cash costs have sort of come off, but not as strongly as sustaining costs. And that's because of these factors. I mean, a major portion of cash costs comes from labor, which doesn't typically come down as easily. Fuel costs, you would think, would have come off in recent quarters. However, it's diesel that they use, and the cost of diesel is not necessarily come off as strongly as crude oil prices. So the cash costs have not come off and are not that easy to bring down. Secondary supply is off, and it's been declining since 2013. It's very sensitive to prices. It accounts for about a third of total supply. And the only country where you haven't seen secondary supply come off quite as sharply, or actually was rising during 13 and 14, was India. And that's because of all the restrictions, the government restrictions that boosted the premiums on gold, which encouraged a lot of the demand domestically to be met by secondary supply. So you actually saw secondary supply in India go up while it was going down in other parts of the world. So with that, I'll pass this on to Mu, who'll speak about fabrication demand.
Okay, thanks, Rohit. I'll try to go through this relatively quickly because of the time constraints here. So I'll touch on fabrication demand in central banks. And with the gold fabrication demand, as many of you are probably very familiar with, jewelry demand is a major portion of fab demand, accounting for roughly 86% of total gold fab demand in 2014. And this means that gold fabrication demand is very price sensitive, with prices dipping for the second consecutive year in 2014. The consumers still are not rushing to buy gold as they did in 2013, even though the prices have declined to low levels last seen in 2010. What's happening in the market is that potential buyers of gold jewelry have been questioning how low prices could go before they make more purchases. And as a result of the lack of rush in gold buying, jewelry demand growth slowed from 13.7% in 2013 to 1.7% last year. and that weighed down fabrication demand growth from 11.3% in 2013 to 1.2% in 2014. The jewelry demand growth, as a matter of fact, we tend to say that the investment demand it's the most important driver of gold prices, where jewelry demand growth also could be playing a more pronounced role going in the past few years and going forward. One of the key attributes of jewelry demand is that consumers, especially in developing countries, tend to buy and hold gold for a relatively longer term compared to the short-term nature of investor gold buying activities. And jewelry demand as a percent of total supplies had risen to nearly 65% from 52% in 2011. And jewelry demand also has been linked to a variety of factors, both culturally and economically. And when making their gold jewelry purchases, consumers don't commonly give a lot of thoughts into the Fed's interest rate policies. And the factors, as seen below, I've talked about the price volatility and price impact on gold jewelry purchases, but there are also a number of other factors that could be prominently factored into the gold jewelry demand. One such key factor is the growth of disposable income in the various countries, as well as the sentiment among consumers. And as we have seen, there has been very strong growth in disposable incomes in developing world, particularly in China and India, and these two countries will continue to play an important role in the jewelry demand growth. There are also other country-specific factors. The relaxation of India's import restrictions have, to a large extent, freed up more purchases for gold. Japan's consumption tax increase in April 2014 has also resulted in a rush to buy gold in 2013. And in the following 9 months, we saw demand has weakened in the country due to the higher taxes. One major factor that's affecting gold jewelry demand is also the fashion trends and the technology behind the switch in fashion trends. One interesting example is the adoption of 3D electroforming technologies in recent years. These type of technologies enable gold fabricators to produce lightweight, delicately designed pieces, often with a hollow center. And that technology helped increase the hardness and corrosion resistance of gold, enabling many designs. And in some cases, it could bring a material savings up to a third. While there are many fashion trends are in favor of pieces with a lighter content of gold in these jewelry pieces, it does not necessarily mean that it's going to trigger a drop in gold jewelry demand, and that these technologies will make gold jewelry pieces more affordable to a wider range of consumers. And the other factor is that with the declining gold prices, as well as the lower per unit gold content, so people in the developed world are able to purchase more gold with essentially the same amount of money. And talking about looking more specifically at China and India, in China, we saw gold jewelry fabrication demand fell by 6.9% last year to 21.4 million ounces. And this is a first annual decline since 2002, when decline fell by around 4.8% that year. We source our demand figures from the China Gold Association, who polls surveys the major consumers in the country. One thing of note is despite this decline and the real consumption of gold jewelry in China, this is still the second highest year in terms of gold purchases in the history of Chinese gold demand. And consumers have bought a lot of gold in 2013, and in 2014 they're like, oh, wait a second, let's see how much more price discounts can we have, and they are less in a rush, and they tend to buy price dips rather than rather than in a time of needs during weddings and festivities. And this behavior change, we think, has a pronounced impact on the seasonality of fabrication demand in the country. So Chinese jewelry demand tends to be heavily weighted at the beginning and the end of the year due to the Lunar New Year related festivities and weddings, as well as in May when there's a lot of traveling and weddings. But these seasonalities, well, it's still likely to be in place in the future years. Will likely to be in some fashion diluted by the more rational buying behaviors of the consumers, who are more likely to buy on price dips rather than waiting until a certain time of the year to make their purchases. One other implication is that when prices are perceived to have reached a bottom, which is likely to be the case in 2015 or 2016, consumers who have been on the sidelines are likely to get back as buyers, which could push gold jewelry demand higher. In India, we think that the country could play a even more important role in the global fabrication demand in 2015. So there are many factors that are in favor of growing jewelry demand in the country. The government has partially scaled back its import restrictions since November 2014 and could further scale back these restrictions in 2015. The rupee has declined sharply in 2013-14, but it stabilizes so far, which should be able to help support import demand. And we also are seeing a busier marriage season for 2015 compared to 2014. And also we are expecting a stronger economic growth in the country, which is conducive of demand overall. So another 14% of gold's fabrication demand comes from electronics, dental implants, medical devices, and other industrial products. The major portion of gold's industrial demand comes from the electronics sector. And this source of gold demand has declined 2.3% last year to 13 million ounces. Continued thrifting and substitution of gold has weighed on the source of demand. In the past couple of years, the substitution of PCs with smart devices also have an impact on the gold that's being used in the sector, and that smart devices use less gold on a per unit basis. But this trend is largely behind the market. In 2014, we already saw a sales growth of tablets had been slower than what the market has previously expected, and also less than decline in the sales of personal computers. And going forward, this source of the industrial uses of gold will continue to be somewhat stable. The gold that has been substituted is unlikely to be brought back into these devices. And gold still faces a lot of competition from silver and palladium and their uses in the electronics industry. So moving on to official transactions. In 2014, central banks turned net buyers of gold after recording a marginal decline in their gold holdings on a net basis in 2013. Net additions to central bank gold reserves stood at 5.5 million ounces, and that compares to a net reduction of 0.6 million ounces in 2013. On a gross basis, central banks have added about 9.5 million ounces of gold to their holdings, and that's up from 6 million ounces in 2013. So most of the increases of gross central banks gold reserves additions could be attributed to Russia. The country added 5.6 million ounces of gold to its official reserves, which is up from 2.5 million ounces in 2013. Russia, of course, it has been one of the largest buyers since 2009. So 59% of the purchases in 2014 could be attributed to the country, and the country's central banks buying reflected their worldviews toward international politics and the political distrust toward the Western countries, as well as the central bank's need to diversify their foreign reserve away from the dollar. So this worldview has also been shared by other notable buyers such as Kazakhstan. And one monetary authority that emerges as a net buyer in 2014 is the Central Bank of Iraq. According to the data that's available to this report, the country's gold reserves increased about 1.5 million ounces from the end of 2013 to 2.9 million ounces in August 2014. And that reflected Iraq's unique circumstances, as it was plagued by civil war and the political turmoil in the country. And the central bank's action was an effort to diversify its foreign reserves and also stabilize its currency against further volatility. The gross selling of central banks' gold reserves last year declined to 4.0 million ounces, and that is down from 6.3 million ounces in 2013. The largest reduction still came from the Bank for International Settlement, which reduced its gold holdings by 2.6 million ounces during the year. And that was a reduction from the net reductions of 5.5 million ounces in 2013. So the BIS was unwinding its gold dollar swaps, and most of such liquidation have already occurred in 2013, and this liquidation have slowed over the course of last year. The BIS entered into these gold swaps in late 2009, 2010, when there is concerns about the liquidities of European central commercial banks after the Great Recession. And these dollar gold swaps were designed to bolster the dollar holdings of these commercial banks, allowing them to meet increased liquidity requirements. But after the European banking system got on a better footing than it was in 2009, the BIS started unwinding some of its gold swaps. But given the fragile recovery of the European banking sector, we think that the liquidation, the unwinding of gold dollar swaps may not necessarily be all unwinded in 2015, and such liquidation could slow further in this year. And one of the aspects, one of the data aspects that separates our research from other market entities is that we factored the aforementioned gold swaps that has been built on and liquidated by the BIS, which is a data series that's historically included in the IMF database. And one other aspect and the data that it distinguishes us is that we generally remove the gold reserves additions reported by the Turkish Central Bank after the introduction of their reserves option mechanism since September 2011. And so the reserve option mechanism of the Turkish Central Bank allow commercial banks to meet a portion of their reserve requirements with gold. And that gold is ultimately owned by investors. To include that gold into the official gold holdings would have been double counting. So between October 2011 and December 2014, the Central Bank of Turkey added about 13.3 million ounces of gold to its reported reserves through the ROM. The additions of the officially reported gold through ROM actually slowed significantly in 2014 from the previous year because the utilization rate of this policy tool has approached a level that is close to the upper limit allowed by this official regime. Only about 0.3 million ounces of gold was added to the Turkish gold reserve through such a mechanism last year. And we estimate that only 3.7 million ounces were actually held in the official monetary reserve held by the Turkish Central Bank, and that is a level unchanged since 2002. So we generally expect central banks to remain positive toward gold as they continue to diversify their monetary reserves, which is currently mostly held in the dollar. And the amount of the gold that central banks are likely to purchase in 2015 will be largely reflective of their political views and policies beyond the price of gold. We think that the few central banks that have been buying gold in 2014 will likely to continue to add to their gold holdings in 2015. So with that, I'll hand over the podium back to Jeff, who will make the conclusion remarks.
Thank you. In the interest of time and the fact that we're going to have this moderating session, what I thought we would do is just not have questions on the CPM group survey and go right into our next presentation, which will be Henner Asche. You're going to make it happen for us technologically. Henner is the deputy head of global markets for the Bundesbank. He joined us last year and made a presentation on the Bundesbank's gold policies, which was a very fascinating presentation, and it was a learning experience for me because what he did was he focused on why the Bundesbank has gold, how it came to have gold, and what its policies toward gold were. And he largely ignored a lot of the static in the gold market about the Bundesbank's gold. And he has graciously agreed to come back and update us on it. So,
how to move forward?
Just click forward.
Is to scroll?
Mm-hmm.
Scrolling, okay.
This is your first time.
Okay, so this is on the screen now. Okay. One back, like this. Okay. Okay, excellent. Okay. Dear Jeffrey, dear ladies, dear gentlemen, dear colleagues, some over there. It's a great pleasure to be here again. As you just mentioned, last year I had the pleasure to attend this evening on gold for the first time. And tonight I listened to very, very impressive, comprehensive presentation. I only have one remark. In Germany, we would never use the word scrap when it comes to gold. Okay. Last year, I tried to create transparency on the Bundesbank gold reserves, on our new gold storage strategy, and our relocation program. In Germany, the gold topic still attends a lot of media attention and sometimes also abroad. And in Germany, a lot of emotion is attached to the topic of gold reserves. Maybe that's why we don't use the word scrap. The Bundesbank is with nearly 3,400 tons, the second largest gold holder in the world after the United States. And the German public in general appreciates the Bundesbank's gold reserves as national wealth, and in that sense untouchable. Last year I explained how our gold reserves developed, how they steadily increased since the early 50s to the late 60s during the so-called German economic miracle, the period of the European payment union, when the current account imbalances were cleared and settled in gold in Europe, the time of the gold pool, and later on the time of the Bretton Woods system, when the Fed was obliged to pay out gold in exchange for US dollar. And then I introduced to you our new storage plan. I will reflect on this in a minute. However, let me start with a global view on central banks' gold holdings. We have seen a similar slide a few minutes ago. And I guess here we can make two observations. First, with the turn of the century, gold seemed to have lost attractiveness for central banks. And many central banks sold gold. The Bundesbank kept its gold, as she always did. Then after the Lehman collapse, gold became attractive again for central banks in the context of the financial crisis and the extremely expansionary monetary policy. And the Bundesbank was not among the central banks that bought gold in the market. Second observation, among the largest gold holders in the world, United States, Germany, Italy, and France, gold counts for more than 2/3 of their total foreign reserves, which is quite a considerable amount. But I guess that all these national authorities feel quite comfortable with this situation. So why is the Bundesbank? Why is it the Bundesbank that is holding the gold reserves in Germany and not the Treasury or the Ministry of Finance, like in other countries? This is not true for Europe. It has always been the Bundesbank which had the duty to hold the reserves. And also, it's written in the Treaty on the Functioning of the European Union that the European central banks shall hold and manage the official foreign reserves of the member states. So not the government, not the treasury. And it's also repeated in the statute of the European system of central banks that it's the basic task to be carried out by these national central banks to hold and manage the official foreign reserves of the member states. And it's also reflected then in the Bundesbank Act that's cited here and as a legal basis. So I guess it's without question, as it was in the past, that the Bundesbank holds the gold reserves in Germany. So what happened to the Bundesbank gold reserves over the last year, let's say in 2014? Shortly speaking, we kept on relocating. If you just take a look at the fourth column from the right, you can see that we increased the volume of gold in our vault in Frankfurt by 120 tons. So where did these tons come from? We took 85 tons from New York to Frankfurt and 35 tons from the Banque de France in Paris to Frankfurt. That gives 120. So, but in total, there is a decrease by 3 tons. And this is very easy to explain. Since several years now, the Bundesbank has been selling gold to the federal government of Germany at market prices. And the federal government of Germany then is minting gold coins, these 3 tons, and then they sell it with an add-on to the general public. So this is the only change we have in our gold reserves over the last 10 years or 15 years, one can say, when that we from time to time sell gold to the federal government to print gold coins. So if you look at the overall storage plan, You can see where we started in 2012. We had 4 storage locations. We had Frankfurt, we had New York, we have London and Paris. And if you look at 2020, that's the column on the far right. That's, so to say, our targeted allocation, which we will reach in 2020. So then at that point of time, we will have half of the gold in Frankfurt and our wards, 37% in New York, and the rest in London. But let me say, the decision to explain this new storage plan for 2020 in the year 2013 to the general public was designed to build trust and to build confidence domestically. And the Bundesbank also made clear that it will preserve its ability to exchange gold for foreign currencies. That is to say, to save its ability to monetize gold reserves at gold trading centers abroad within a short space of time and without any logistical constraints. That is why a complete relocation of all gold reserves to Germany is not appropriate for us. You might remember we were the first central bank, at least in Europe, to publish details of our storage facilities. In the meantime, others followed. It began in 2012 when the audit of our gold management by the German Federal Court of Auditors has completed its audit at the end with good results, and also the Budget Committee of the German Parliament acknowledged the court's report. However, the court suggested the Bundesbank a more in-depth, physical inventory and stock-taking of its gold holdings abroad, besides the book inventory and the accompanying confirmation by the depositories, as it has been practiced over a period of decades and has been confirmed by all external auditors. So we were stepping in a kind of new world, but the court never demanded the Bundesbank to relocate its gold reserves. It always emphasized that the decision where and how the gold is stored rests exclusively with the Bundesbank. So this was a decision taken by the Bundesbank in its complete independence. It is not a response to political pressure. And as I already mentioned, the Bundesbank is the owner of the gold reserves. So the German national government has no power of disposition and has no claim on the reserves. And the same is always true, also true for the German Parliament. So to make it very clear again, we do not transfer parts of our gold to Germany because we have doubts about whether the gold does still exist. We were never ever in doubt about the reliability of our highly esteemed partner central banks, and we are always very grateful to their part in storing our gold. And we have a very great deal of confidence, of course, in the security of our gold holdings abroad. So there is also no reason for us to rush through this relocation process. We have time to until 2020. The cooperation with the Federal Reserve Bank here in New York and the Banque de France in Paris is cooperative and always very constructive. And besides, the Bundesbank is working also in close cooperation with the BIS, the Bank for International Settlements in Basel, the central bank of central banks. The BIS is a repository of expertise in the relocation of gold, and of course it's a trustworthy institution. The Bundesbank remelted gold bars in Europe, taken here from the Federal Reserve Board, to ensure they met the London Good Delivery Standard, because the gold stored here in the Federal Reserve does not fulfill the so-called London Good Delivery Standard. The remelting process was audited independently to make sure that the German gold was not mixed with other gold. You know, there was a lot of conspiracy in the market, in the media, so we always wanted to be on the safe side on this. And it is essential that the gold holdings abroad comply with our holdings on our balance sheet, with regard to volume and with regard to quality. And this has been confirmed by all our relocations so far. All examinations, all controls, all checks have been carried out without any complaints, and they were all completed to our utmost satisfaction. So our accounting is therefore correct, as we have always anticipated. So, and as mentioned before, we can stop over here. Okay, let me add one remark why we, so to say, take all gold away from the Paris wards. Because the relocation policy we are following so far partly also reflects the change in the overall legal framework we are living in. So given the introduction of the euro as a common currency, it is no longer necessary to have gold reserves in Euroland. So it's no longer necessary to have gold reserves in France in order to exchange gold then for international reserve currency. It doesn't make sense. So, where are we now so far? We started the process in 2013 and we continued it in 2014. So, as already mentioned, in 2014 we relocated 120 tons, 35 from Paris, 85 from New York. And it also has also been made public in the meantime that the Bundesbank took advantage of the transfer from New York to have roughly 50 tons of gold melted down and recasted then to the London Good Delivery Standard. Not the complete 85 tons, just 50 tons of it. And as you also can see here, since the transfer began in 2013, the bank has relocated a total of 157 tons to Frankfurt. And this makes roughly 23% of the total quantity we have to transfer. So you see we are right on track. And the Bundesbank assures the identity and authenticity of German gold reserves throughout the whole transfer process, from when they were removed from the warehouses abroad until they were stored at the end in Frankfurt, in Germany. And as soon as the gold was removed from the warehouse locations abroad, Bundesbank employees cross-checked the list of bars belonging to the Bundesbank against the information on the bars removed. Finally, once they arrived in Frankfurt, all the transferred gold bars were thoroughly and exhaustively inspected and verified by the Bundesbank. And when all the inspections had been concluded, not a single irregularity came to light with regard to the authenticity, with regard to the fineness, or with regard to the weight of the bars. So, all in all, we are very much satisfied with our relocation program so far. Maybe you remember then we released the data for the relocation in 2013, and the public realized that only 5 tons have been moved from New York to Germany. They start to extrapolate these 5 tons and say, oh, they can never make it until 2020, when they kept on this very low pace of transferring gold from A to B. But it was clear that at that year, we just started the process, and it's a very complicated process, and many authorities are involved in it. The people working here in the Federal Reserve, also the people working in the vault of the Federal Reserves, the transportation companies, the melting companies, and then again bring it back to Frankfurt. And our staff in the ward, it all has to be, so to say, put in line and organized in a very way so that the process at the end can be managed in a very swift way, because every day costs a lot of money, because all these transportation and these transfers were insured somehow. Okay, so that's where we are now. And here, let me start with this last picture here. Usually we store our gold in Frankfurt in boxes, closed boxes. It's not very attractive to see these boxes. What we also have in Frankfurt is a show ward, where we put several thousand bars, which are from time to time presented to selected people. I can tell you it's not that easy to get into this ward, but it's not more complicated to get in here than to get in here into this building. So this February, we released a short film about the German gold reserves. It just takes 10 minutes or 8 minutes. And it's available on the web page and on YouTube. And it shows you, it gives an insight on the process, how it's, so to say, organized. And it's quite entertaining. And it's really made for the general public, because we try to be even more and more transparent on what we are doing. So if you like, just click on it and enjoy. Thank you very much.
Very good. Very good. Thank you. Our next speaker is Harriet Hunnable, Executive Director of the CME. Let's see if I can know how to do this. I don't know how to do this. I'll let you do it.
Yeah. Okay, let's get yours, Harriet.
While we're getting started, why don't I just kick off with a short introduction. Thank you very much, Todd. Well, first of all, thank you to CPM and also to Bloomberg for inviting me to join this year's release. CME Group has supported the CPM precious metal publications over a long period, and while we've had presenters join some of the other panels, I was delighted when Jeff asked me to do this. I'm just reminded, when I was listening to Henner's presentation of how the world has changed when there's so much more transparency, and we can look at the Bundesbank's reserves in Frankfurt on YouTube. And in English too, which for us is great, but it just shows how the world has changed. And we've been very pleased to support CPM, because we think that it's important to bring greater understanding to our markets. We have a lot of data, a lot of different publications available, but I've very much enjoyed the clarity and the understanding that CPM bring to our markets, both on the COMEX, but also across the cash markets and other derivative markets as well. So I think it's very important that we, as an institution at CME Group, we do what we can to provide transparency, to help people to trade with more confidence, but also across all of our markets, it's important that we have this. And CPM Group has a beautifully written piece of work as usual, but also is promoting greater understanding of our marketplaces. So I'm responsible for the precious metals businesses on CME Group, and that includes our precious metals on COMEX and NYMEX, but also what we do to support the OTC markets. And I'm going to speak on two things, as I've been asked to update you on what CME Group is doing across the complex. Two things: how we are adding infrastructure to both our exchange products, but also to other markets, and how we are increasing the number of contracts and the functionality on our exchange. How do I do that? Am I using the right thing with the clicker? So, thank you. So just an update on what we are doing as an exchange. We are adding infrastructure to what we do on the exchange, and we are also providing more infrastructure to other markets. And it will be no surprise to you that the direction of travel across different markets is towards exchanges and towards clearing. So what have we done in 2014? Well, one key thing that we did is that we were very much involved in the London markets and the transition as they considered what should happen with the silver fixing and then later with the other fixings to get these into the right shape for the future. And we wanted to ensure that there was continuity to these important benchmarks. We did a lot of work to assess what users needed from fixings in the spot market. And we came back to the beginning to how the methodology for the fixings had been pulled together. We reassessed that and found that was what end users want. It was what the London liquidity providers wanted to support. And we provided the methodology for that to go onto a platform, and we worked with Thomson Reuters administrators to bring the oversight that this benchmark needed. And now we are about to move into a new period where both gold and silver are regulated benchmarks, and they'll be regulated by the FCA from the beginning of April. So we are very pleased to have supported that transition, and we believe that there'll be more work that we look to do. We've certainly very much invested the right resources in our platform. It's been running since August, and also our engagement with both the regulatory authorities but also with participants. It's very important that we see an increase in participation in these benchmarks for them to be believed in, for them to be successful, and we've increased the participation around silver, and we look forward to being able to do more of that in 2015 and 2016 as well. I think it's really critical that these benchmarks are more believable in the future, and that as well as being more robust and approved by regulators. So we're doing what we can to bring that to bear. We last year invested in providing more centrally cleared product on our European clearinghouse, that's CME Clearing Europe, as well as supporting the resources that we have for clearing of OTC contracts through our US clearinghouse. We continue to publish a forward curve for the OTC market. Now there is no GOFO rate, there is no other data that is provided by other exchanges. We continue to resource the data that is important for the OTC market so that they have an OTC curve for the local London market. Last year we introduced a spot contract in December onto our CME exchange in London. This can enable the transition of the fixings onto a cleared model. We certainly believe that this will be constructive in terms of price discovery, true price discovery on equal terms, but also that it can increase wider participation around these benchmarks. So those contracts were put in place and approved by the Bank of England onto our clearinghouse last year, and this year we begin the much more difficult work, I think, to help all of the external agencies connect to that so that the platforms can work with central clearing, and also the benefits of that will be significant for the forwards market, where forwards can also use the same connections to clear forwards and other OTC derivatives. We provide reporting. SDR is available for reporting of US derivatives under the US mandate for reporting of derivatives. And in Europe, we have an ETR, a trade repository set up, which again satisfies the requirements in Europe for reporting of both on-exchange transactions, but also OTC transactions. So we provide this infrastructure to support our exchange market, but also to support other marketplaces, to support contracts that trade in other markets. Okay, I got it this time. In 2015, in January, we launched a new kilo contract. Our big GC contract trades 23 hours a day. It has the most significant liquidity of any international market, and it is a benchmark flagship contract. We provide all the necessary infrastructure around that. This year, we've launched a contract which is specifically a 4-9 kilo contract, which is deliverable in Hong Kong. And it's been trading for several months now. We're going into our first delivery cycle in April. We're very pleased with the liquidity that's been built up around the clock on that kilo contract, and also with the number of participants that have grown and the movement away from the initial liquidity providers into a more diverse universe. We see retail starting to trade this. We saw good trading both when Asia is open, but also during the lunar holidays in China. This contract was trading. Last week we had a high. It's early days now, so the volume is picking up. It's growing from the hundreds, but we're very pleased that we've been able to provide this new contract. This contract is physically deliverable in Hong Kong. The rules of COMEX apply in Hong Kong, and we have inventory in Hong Kong for these deliveries in April. We call it the Easy Arb because we uniquely are able to provide the offsets between our big contract in Loco, New York, and with our contract in Hong Kong. So it's an easy arb for those that want to trade New York versus Hong Kong, Asia. It is also a contract that enables people to manage price risk if they're trading spot in Hong Kong or in the free trade zone and across other market centers in Asia. But we think that what is happening in China is very important, very exciting, and we're very pleased to be able to offer the facility to take delivery or to put material onto the exchange in Hong Kong as a first step towards increased customer choice for contracts. What we also did in 2014 was to increase functionality on our platform. One of the key things that we have developed and has had significant results is RFQ for options. And I know that in the CPM data, you'll see a lot more information around option trading and implied volatility there. But what that has meant is this highly electronic market. Over 65% of volumes traded in options on COMEX are through the electronic platform, which means they are universally available to traders. the RFQ has enabled more complex transactions to go across the exchange and has also reduced execution risk. And last year in 2014 in November, the open interest of our options complex hit a record with 186 million ounces of open interest in November of options on the exchange. So as people try to manage risk across different markets and in different ways, options play an important part of that, and we're very pleased that we've been able to continue to invest in a number of different functionalities. But I just wanted to focus on that RFQ because it's something that if you're a trader, it matters to you, and it's having an impact in terms of the quality of market and execution risk that people experience on our platform. We continue to invest in transparency and in providing more data in terms of what trades on the exchange. We're also very pleased that our economists are able to provide thought pieces to give you some context as to what is happening in our markets and to enable you to understand what factors might come to play in those marketplaces, in our markets. Eric Newlands, newly joined CME, has done a piece on the oil-gold ratio. I was very pleased to see that CPM has also focused on this really interesting ratio. We've had a lot of ratio trading of gold with other precious metals, but I think the oil ratio is important. So he published a piece earlier this year on the oil-gold ratio, which I think tells us about what the future lies for our economies. He's also recently published a piece on the risks to the downside on gold and silver, and highlighting that that risk to the downside is more significant in the short term or this year than to the upside, but to be aware of the possibility of an equity correction, which, again, Rohit, I think you focused on that here, that the Fed rate may be delayed, and that there continues to be instability factors, particularly in the Middle East, and the strong impact of currency, the US dollar on our markets, as well as the potential for Eurozone problems, although that seems to be less of a factor today than it was a year or 2 years ago. Just to come back to our kilo contract, I was in Shanghai last week and was very impressed to see what further developments is happening in China. I love the fact that CPM brings that context. Look at Switzerland, look at the universality of the desire to hold gold, whether it's in New York or in Frankfurt or in Switzerland or in China. But I think what's happening in China continues to be important. It's certainly something that focuses a lot of interest in the gold market, and we see that the COMEX GC contract as well as our new kilo contract is an important way for people to be able to manage risk in those centers. But what I was also impressed about when I was there was this huge desire to see gold trade in renminbi. Through what's happening in the free trade zone, the access to the contracts on SGE in the free trade zone, as well as the way in which you can touch the main board contracts through the free trade zone. There's a huge desire that we have to take seriously about trading gold in renminbi. And SGE has set up a system whereby you can trade gold in CNH, and as Jeff pointed out, it's likely that you can trade gold using US dollars for margin and for fee payments. But what I'm seeing is a great desire to converge the rate for CNY with the rate in CNH, that they see gold as a very important asset, as something that they want, the first commodity that will trade in renminbi, the first commodity that will really have a difference on how people can get Chinese exposure or exposure to the Chinese story. Not just equities, not just bonds, not just against the US dollars, but also through gold. And I think that one thing that we're going to be focusing on this year is what that means for the derivative liquidity that is available today, the 30 billion derivative liquidity that is available for the CNH. If this really continues to grow, if this takes off and people really test the ability to trade gold in renminbi, this is going to change the dynamic of the market. Not necessarily in terms of pricing, as Jeff pointed out, because there is very good price discovery across our markets, but in terms of creating a new trade. And we're pleased that we have the kilo contract in place, which enables people to trade and manage their price risk in Hong Kong, but also to use as a means to manage risk in other parts of that region, including the free trade zone. So thank you very much for asking me to come and speak, and I look forward to joining the panel. But again, I'm so pleased to see another beautifully written book with providing clarity to the market on what's really going on. So thank you.
Our next speaker is Chantelle Schieven. She's an economist with Dundee Capital Markets. She joined us last year. She has a background and a degree in monetary economics, I guess, and has great insights into it all. So I'll just leave it to you.
Thanks for setting it up for me.
You're welcome.
So you guys will be happy to know I narrowed it down to my favorite 85 slides.
Good luck with that.
Well, maybe a few less than that. So thank you again to the CPM group for having me back, and to Bloomberg for hosting. It's always a great pleasure for us to get to come out to New York. We live way on the west coast of Canada, so it's nice to have a bit of change of pace. And last year, my theme was that we were cautiously optimistic on gold. Well, this year we're cautious and optimistic long-term on gold. So we're still cautiously optimistic, just changed it around a little bit. So we're going to go through just briefly. I picked the top 3 bearish factors, the top 3 bullish factors that we're looking at. We definitely have a lot more, but I wanted to just give you a little bit of thought on, and I can't make it work either. Is it just the right one?
I use the arrows on the keyboard.
Well, there you go. Whoops. Nope.
These.
Oh, those ones. Sorry.
Try,
Nope.
try this one.
It moves that one, but it doesn't move this one.
Todd?
Todd left.
Todd left.
Okay. So as we figure that out, we'll just talk about,
you
we'll
go.
start,
I use the center thing.
the center thing. Perfect. Thank you. So we have our bearish factors for 2015-16 is, the first one is this US dollar. And although gold sometimes can move in correlation with the US dollar, definitely in the last 2 years, it's moved in inverse correlation. And part of this is we put as the US is losing the currency war, but really it's a change in policy. You had the Fed really loosening policy from 2009 through basically last year, and now you have other central banks that are loosening policy, and the Fed's actually talking about slightly tightening policy, although we think it's going to be very slight, and it's still a very loose policy all over. World economy, I mean, if you don't have growth in the world economy, it's hard for people to have money to buy gold. So you think about that. We think it's going to keep oil prices depressed, which means, a lot of, there are some gold buyers that buy it as an inflation hedge, which we do not think. We also believe that inflation is going to be, more deflationary concerns are definitely prevalent for the next couple years. And then people have other assets. Investors have other places to invest their money, and we use the S&P as kind of a proxy for this, that the S&P has been doing really well. And since we think the Fed's going to be somewhat very mild in their increases, we think it's going to continue probably through this year. wrong way. So we did a little analysis. We had a lot of our clients that were asking, well, if the Fed does increase rates, what does that mean for gold? Is the Fed funds rates really correlated with gold? And we actually went and looked at that, and then we said, well, that's not really what's driving it, it's the dollar. So we took the kind of the uptrends and downtrends in the dollar and matched it up to the gold price. The gold price is showed in log form on here just for simplicity and visualization. And we really looked at what is the correlation on that. And as you can see for the last couple of years, this goes back to already 79, we're using weekly data. And as you can see, the dollar overall is very inversely correlated with gold. So we think the strength in the dollar has a lot to do with the decline in gold price going forward. Keep going backwards. The second one was the global economy sluggish. Gold generally doesn't do well during recessions. The exception to that is when you get a lot of liquidity from central banks. But as you can see, we've just charted the last two, the Great Recession in the US, and now we're considering kind of the Eurozone is in recession, no growth type environment, really fighting off deflation. And gold, in those circumstances, it's difficult for it to get a foothold. The reason that we really look at slow growth is we've taken this as an annual chart, and the blue bars on it show world growth, world GDP growth. The two lines on there are two different indexes for commodity prices. And gold definitely falls into this category. It fits into here, that if world growth is less than 4% annually, then it's very difficult, or we find that commodities don't generally have year-over-year gains. So we're really just looking at an overall picture on commodities, and so the world growth feeds into that. The next one is I keep doing it backwards. The next one is the equity markets. We think that they do have some room to rally. We do think that they are a bit top, but we've kind of keep thinking if the Fed does keep their rates, even if they do a 25 basis point rate, go up to the next range, that's still positive for equity markets through this year. And maybe, next they might level out some, but we do think there's a lot of other investments for investors to kind of keep them on hold. And then we'll just look at three of our bullish factors. We do think that Asian physical demand will continue to expand, and we don't focus all of our attention on that, but we put that number one because Asia, which we'll see in the next slide, Asia demand is a high part of the fabrication, and also it was alluded to earlier. And also the low oil price is a net benefit for consumers in both the two biggest markets, China and India. We think that this is a little bit more this is where we get more optimistic, going a little bit long term. We think the global debt crisis is going to worsen. We think that debt is tending to grow faster than nominal GDP, especially with really low inflation, and that monetary policy is going to remain loose. And like I said, even if the Fed does tighten some this year, we think it's going to be a very slow process because economic growth just is not strong enough. And then we think that geopolitical crisis and financial crisis are going to be a big theme, especially in the next 2 years. We have a lot of things going on in the world, and the gold price tends to increase when these heat up, and although it does come down, we still get some gain in there. So first, if we talk about China and India, they are becoming richer. You're getting more of a middle class, and they do account for 47% of the consumer demand of gold right now. That was in 2014. I'm sorry. That was that was fourth quarter 2014. That they do account for a high part of that. The second one is, the global debt crisis. One of the things is, one of the themes that we go with is governments are really burdened by entitlements. And this is the US. So living in Canada, sometimes we get, people when we come to the US and you say, you might have the wrong chart up there. I know Martin's experienced that a couple of times in that, you don't realize just how much of the US budget is also going to entitlements. And over 50% of outlays are for Medicare, Medicaid, and Social Security. even in the U.S. And as populations age, this is also putting more and more strain on U.S. governments. So you can see, the debt, this is the projections from the IMF, from their fiscal monitor. Debt has been rising, and we think it's going to continue to rise, especially with low inflation. It's very difficult for governments to reduce their debt levels if they don't have any growth. So this leaves governments with choices. So they can either cut services and raise taxes. The problem with that is people don't vote for those policies. It's very rare that you're going to have a politician go out and say, I'm going to cut your services, I'm going to raise your taxes because we need to cut the deficit. As long as it doesn't apply to you, you might vote for it. But when it starts applying to you personally, it's very difficult to get people to vote for those. So instead, governments tend to go for growth. They tend to inflate, devalue. Sometimes you get, and then you work into default and financial repression. And those are positive for gold. Geopolitical, I just put the last one on here. We've been tracking geopolitical events. We go all the way back. The biggest one was the Iran crisis. But this is just in the last basically year and a half. And you can kind of see when those crises heat up, the gold price shoots up. And although it does come back down, to some level, you usually do maintain a portion of that increase. And the reason that we think geopolitical crises will add this year is you have the Greece is really trying to renegotiate and work out all of their issues coming up. And then there's Russia, Ukraine are still working out that. And then we also have the U.S. Negotiating with Iran. And there's a lot of those things that tend to kind of come down to the very deadline, and markets get really nervous. People go into the safe haven buying. And so I'm just going to leave you with our forecast. So we put this out at the end of last year. We're actually updating it in the next week or two. But we kind of looked at a weighted forecast for this year, the average of around 1237. We do have it increasing past there, but we think the crises just last year, we had at the beginning of the year, we put a forecast of about 1250. And if you subtract out of the average, which was 1266, the crises, it came in just over 1250. So we think 1255 if you add those in, because we don't put those in our models for a forecast. So I'll leave you there so we can get started on the panel. Thank you for your attention.
Have a seat.
Just choose any chair.
Sorry?
Choose any chair.
Why don't you sit wherever? Yeah. Okay, I'm Steve Jonathan. I'm an economics and currency market specialist at Bloomberg. I'd like the panel to take their seats, and we'll get started. While they're sitting down, I just introduce myself. I'm as I said, currency and economics specialist. I've been at Bloomberg about 5.5 years. I spent about 30 years at several large banks doing foreign exchange, and before that I traded commodities for a small little commodities company based outside of Minneapolis. The only person I actually want to introduce formally is my colleague Josh on the far right. He's an economist at Bloomberg, and Josh actually spent several years at the Fed. And one of the, if you want to know how and when the mortgage-backed security book at the Fed was built, speak to Josh.
I'm also happy to tell any of you about the Federal Reserve Bank's gold vault, if you're interested in that kind of anecdote.
So I prepared a couple of questions myself. We have a couple of mics we can float around, but just to kind of get right to it and start out with the first question for Josh, I think, looking at the annual yearbook and the macro factors that were considered to be important for this past year, obviously this next year, the Fed, the duration, the magnitude, the speed of whatever they do is obviously quite important, and you can see that in a rally in gold in the last couple of days back to January levels when it looked like, per Ms. Yellen's comments, that they were getting a little more trepidation about what they're going to do. So why don't we start out with Josh and let him just give us a few thoughts about how the market views the Fed, how the Fed views itself, and what we might expect over the next 6 to 9 months.
Sure, thanks. So as I'm sure many of you are aware, the Fed is in this very delicate process of trying to extricate itself from its highly accommodative monetary policies. And in fact, that was recast just yesterday when Vice Chairman Stanley Fischer said, look, even once we have our first rate rise, we'll only be moving from an ultra accommodative policy to